According to the Wall Street Journal, a number of companies have been turning some of their underperforming funds to green funds. They're hoping to attract some of the billions of dollars that have been flowing into sustainable investing products lately. And with us now is the author behind this piece, Shane Shiflett, who is a reporter at the Wall Street Journal. Shane, it's good to have you. Tyler and I have been talking about your story all day, and I think our main question is the fund's composition changing when they change their name, or is the name itself the only thing that's really changing here?
Thanks for having me. And the answer to that sort of depends on the fund that you're looking at. A lot of the funds did change their composition, but there are some that remained invested in controversial oil and gas companies after rebranding and calling themselves sustainable.
So is that because they are going to take some time to figure out how to have better composition that meets those goals, or is it because those goals are not the point? The point is the name change attracts a lot of inflows.
Well, I think there's a couple of things going on. First, the fund managers that I spoke to, many of them were able to transition to a new sustainable model within months of rebranding or, in a very short time frame. So I don't think time is necessarily the issue here. Sort of the larger question is, what does sustainable mean? There are a lot of different definitions out there to investors. Are you weighting the environmental component of ESG more than the governance component? So it kind of comes down to what the fund managers want to prioritize in the E, S, and G criteria that they're looking for when they're selecting stocks. And then, of course, you're always looking at performance when you're selecting the composition of a fund, and you want to deliver returns to investors. So at the end of the day, there's still a level of input that returns has on what the fund is going to look like.
To me, there's always the issue of knowing what's in your fund. I mean, it is one thing just to buy a fund, but it is another thing entirely to know what the fund holds. And if you are buying a fund that is self-described as an ESG fund, I think it has to be incumbent upon the buyer to know what kinds of companies are in that fund and whether they meet your sense of what an environmental, sustainable, and governance responsible fund is. Because, as you point out, a manager can pretty much define those things any way she or he wants.
Yeah, I mean, investors should always be looking through their prospectuses and see what the holdings of their funds are, and reading about their fund managers' criteria for selecting ESG stock. But when you look through some of these prospectuses, it's not always clear. The disclosures don't always make it clear what they're weighing and how their decision factors into what they are including. Some of these statements are quite vague, just saying they pay attention to different ESG scores provided by third-party data providers that do these sort of rankings, but the fund manager can choose to disagree at any time.
Let me just bottom line you here, or bottom line the conversation. We can talk about whether environmentally sustainable funds perform better than normal funds. But there's one thing that is not arguable, it seems to me, and that is that funds that change their mission to become a sustainable, environmentally responsible fund, they grow assets better than the fund did before. True or false?
I think you're seeing a lot of really good performance from many of these funds that are rebranding, particularly because they're weighted towards tech stocks, because tech stocks on the whole, and this is a generalization, tend to have a little bit stronger ESG scores. So if you look at Apple's and you look at Google's, they have their carbon emissions are going to be much lower than an energy company like ExxonMobil or ConocoPhillips. So, when fund managers made these changes, they started picking up tech stocks, and those have, of course, performed really well over the last couple of years. And they also happen to be in line with the ESG investing criteria that many of the active fund managers are focusing on right now.